Welcome to our continuing YouTube video series on taxes and the law. My name is Christopher Neufeld of Neufeld Legal. And in this particular YouTube video, we will be discussing dealing with capital losses in the Canadian context. And I make this distinction because in every country, the specific tax regime dictates the particularities of how you deal with certain aspects of income, losses, and the like. And there is a very distinct distinction between Canada and the United States. So, taking a look, what is a capital loss to start off with? Well, it is when we make the determination of a transaction involving capital property, where that transaction results in a negative number. As such, if we were to take the proceeds of disposition on the sale of that capital property, we subtract the adjusted cost base, which is derived in large part from the initial acquisition price, and we also deduct the expenses and outlays involved in selling that piece of capital property, where we come up with a negative number. That negative number represents a capital loss. Now, this capital loss may arise either from the actual sale or what the law considers to have been sold. So there are variances that you have to be aware of. Now, what happens with this capital loss? Well, to the degree you have allowable capital loss in a given year, you can offset them against capital gains that you might have in a given year. So you take your capital gains, you offset them against your capital losses with the objective, where possible, of bringing it down to zero. You cannot necessarily create a negative number such that you're claiming back money from the government, where technically the government was not a part of this series of transactions. Nevertheless, what you can do is, after you net out against the current year's taxable capital gains, you might have capital losses that you could apply to other years. And what years could you be applying those to? Well, you can apply them to the 3 preceding tax years and any future tax year, such that if you had a capital gain in a prior year, you would be able to say, I've had losses in this being a subsequent year, offset it, and get the particular adjustment for it. And that in a nutshell represents the most basic dynamics of capital losses and the use of capital losses. Nevertheless, as with most things in the Canada Revenue Code, in the Income Tax Act, there are exceptions, alterations, specific rules for other property, other situations. 2 of the most prominent being depreciable property and personal use property. As such, even though we provide you with this basic overview, you really need to look at the specifics of the transaction, the capital property, and the dynamics of all your various transactions in the space of those tax years. And that is best done with a tax professional and in consultation and review of the Income Tax Act and the interpretations thereof from the Canada Revenue Agency and the like. I hope this YouTube video has been informative and has provided you with some insight into how you may use capital losses in the Canadian business context. Thank you.